Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about investing in property in outer-lying suburbs. So that is non-blue chip suburbs or investment grade locations as I would typically describe them. And I've noticed that some buyers agents are promoting investing in affordable locations. And I guess on the face of it, I can kind of understand why some investors might be attracted to follow this advice. But it's really not until you delve into the theory and most importantly, the evidence that it becomes blatantly obvious that such investments have a very high probability of underperforming, that is not working, not delivering the returns that you desire, in fact, not delivering much in the way of returns. And when I say high probability, I mean in the long run, it's almost certain to my mind. Now, I've noticed a few posts on social media, LinkedIn and so forth, of some buyers agents sort of espousing the benefits of investing in these sorts of outer area locations, some even regional cities and so forth. And I noticed one particular advertisement like that or post that caught my eye, and I thought I'd use as an example for this podcast. And this buyer's agent was advertising a North Brisbane location where he purchased a property for his client for $530,000. The estimated rental income was $480 per week, and the land size, it was on a large block of 1,006 square metres, which he suggested had subdivision upside. So on the face of it, you think, well, that's not an expensive property relative to capital cities. That's a pretty healthy amount of rental income, and it's a large piece of land, so what could go wrong? Well, after a bit of research, because obviously they don't really advertise the addresses to these properties, but after a bit of research, although they did have the photo, which is the giveaway, after a bit of research, I found that actually the property was located 17 k's north of Toowoomba. So that's not Brisbane. In fact, that's 140 kilometres away from Brisbane. So let's call it a regional city, perhaps, because Toowoomba has a population of only 120,000 people. So it is a relatively small city. There's plenty of vacant land surrounding it, and the property was located, in fact, in a relatively new estate, located by literally an endless supply of vacant land. When I looked at the historic transactions for the particular property, I noticed that the land was purchased for $90,500 in March 2007, which happens to be the first premiership I saw the Geelong Cats win. So I just wanted to drop that in because it is actually important information to myself. Well, to me anyway, I should say, yes. Anyway, and a 5-bedroom home was constructed on that land. Now, the land obviously has probably appreciated over that time since 2007, the value of that land. But of course, the value of the dwelling has and continues to depreciate as well. So this is evidence, I think, by the past growth rate, because the completed property was first sold in September 13 for $445,000. So remember, we bought for $530,000. So about $90,000 more. So therefore, over the past 7 years, the value of the property has only appreciated by 2.5%. Inflation over that time was 1.7%. So you've got real growth of 0.8%. Barely worth the risk. In fact, not worth the risk. Now, the positive attribute is obviously the income from the property, because you might go, well, Stuart, let's say it's not going to grow, but at least we'll get the income. Great. So we're going to get $480 a week, which equates to a gross rental yield of 4.7%, which by capital city standards is a very healthy yield. There's no doubt about that. But the fact is that the property is mostly building value, not land value. It's now a 14-year-old 5-bedroom house. It will start to need an increasing amount of ongoing maintenance, or the property's value will diminish significantly. So I would argue that the maintenance, well, if you're going to put a tenant in there, you've got no question. There's no discretion around whether you're going to complete that maintenance or not. The tenant's going to require it. So that will significantly eat into the rental yield. So 4.7 gross might end up being 2.7 or 2% net. Arguably, you're better off to put your money in alternative investments like infrastructure or global property, or even an income equity strategy investing in Aussie shares for dividends. You're going to get much better returns with much lower risk. So at first glance, something, an advertisement or a post like that starts to look like a good investment. You think, well, it's relatively affordable and the rental income is high, but it's clear that it really doesn't have the attributes to drive capital growth. There's certainly no history of driving capital growth, and the supply-demand indicators indicate that the chance of getting capital growth isn't positive. And then there's also some headwinds in regards to whether it's going to continue to contribute or derive a reasonable level of net income after all expenses. Now, I picked this example randomly. In fact, when I picked it, I thought it was a Brisbane location just because of how the post was worded. But I come across lots of examples of these sorts of properties. Now, they might not be in regional cities. They could be in outlying suburbs. And one thing that I've noticed in business for nearly 20 years in Melbourne is that there's been a long line of buyers agents espousing the benefits of investing in Frankston, which is an outer suburb of Melbourne. It's been lauded as the next growth suburb by many different people for the past 20 years. I mean, I read an article probably every second year that tells me it's a great location to invest. Now, of course, there's going to be some properties in Frankston that have done well in terms of capital growth-wise. There's always exceptions that prove the rule. But I know over the past 20 years, investors have been much better rewarded by investing in blue chip locations as opposed to Frankston. So we're always going to see these advertisements and so forth, but we need to remind ourselves of investment fundamentals. Now, of course, there are some positive attributes. There's some attractions to investing in outer suburbs. The first one is the price point. Now, you can buy a house on 1,000 square metres for just over a little over $500,000. That seems like good value. How can you go wrong? And so that price point is beneficial because either A, you can invest in multiple properties. So instead of buying one, you could buy two or three. And secondly, for those people that have have quite tight borrowing capacities, it might be the case of either investing or not investing in property at all. So that could be the price point's an attraction. And then secondly, because properties in outer locations tend to have a lower land value component, and certainly the land value per square metre is less valuable than land close to the city, typically what you find is most of the property is building value rather than land value. And of course that then drives a higher rental yield. And so that can help affordability too. So if we've got a gross rental yield of 4.7%, setting aside any major maintenance or improvement requirements, that property is probably going to wash its own face. Its income, gross income, will probably pay for all the expenses. And that's an attraction to some people. But of course, so they're the positive attributes, the shine, I guess. It's the lipstick on the pig, if you like. But there's obviously some substantial fundamental weaknesses with investing in these locations. So the first thing to recognise is the supply and demand fundamentals are significantly different. Now, we have to make friends with that, and we've got to realise that's going to have an impact on future returns. So firstly, the supply of vacant land in surrounding localities is typically infinite. It's abundant. You need more land, you just build further out, the city starts to spread. You can't do that in an established suburb. And the demand for property reduces the further you move away from a capital city CBD. And I'll talk about why that is in a second. The second consideration is the tenant profile. Tenants in these locations are more likely to be sort of lower to middle income earners. They're probably likely to be a young family with kids and pets that create a lot of wear and tear on your property. Compare that to, say, a professional couple renting in a blue chip suburb. They've probably got almost zero chance of involuntary unemployment. And they probably don't spend too much time in the actual property. They probably spend time out with their friends at work, all those sorts of things. So wear and tear is lower. And lastly, I think it's super important to recognise that the impact of borrowing capacities over the past 3 to 4 decades have had a substantial impact to price growth in outer suburbs. So that is, the average Australian's borrowing capacity has increased by somewhere between 2 and 3 times since the early 1980s. So, we can borrow a lot more on the same level of income today than what we could 30 years ago. Now, that increases my capacity, and that has driven price growth. But I believe that borrowing capacities have peaked. That trend won't continue. The borrowing capacities won't be 2 to 3 times more in another 30 years from here. They will only move in line with income, and we know people's incomes really aren't changing, so people's borrowing capacities really won't be able to change. So we won't see the same rising tide of the flow of greater borrowings enter into that market. I still think people will be highly geared, but in terms of borrowing capacities, it's going to be more linked to their income than really any changes in banking and so forth. And that means that the historic capital growth rates in those locations won't repeat themselves over the next 30 years. Now, of course, it would be remiss of me to remind you that, of course, there are some real strong attributes of investing in blue chip locations that are unique to these locations that suggest that they exhibit lower investment risk and are going to provide higher investment returns. So we know that price appreciation occurs when demand persistently exceeds supply. And I want to underline that word persistently, because persistently means it never eases up and it's over very long periods of times. So putting aside the affordability considerations, most people desire to live near the CBD, not in it, but surrounding it. And of course, there's a cohort of people that love living in the country, etc., etc. I'm just talking as a general rule of thumb. These locations tend to provide greater employment opportunities, a vast array of different opportunities and career progression and so forth. And of course, they provide better amenities, entertainment, schooling, medical, pastime activities, those sorts of things. But supply of housing is finite and fixed, right? There's only so many houses in Toorak. There's not a lot of subdivision going on in Toorak because the land value is just too expensive and doesn't really lend itself to it. So we're not going to change the number of houses in Toorak. In fact, they'll probably reduce. It's a falling supply rather than a steady or increasing supply. And there's little to no vacant land as well in these locations. You might find a vacant block, very difficult though. Normally there's going to be a dwelling on it, and you're going to have to pay something for that dwelling. You're not just going to get land value. So as such, in these sorts of locations, it's really not difficult to visualize that demand is going to persistently exceed supply. Now, you've got to think about, one of the pushbacks sometimes we get from people is, okay, Stuart, but, these locations, you've already, got to spend $1.5 to $2 million to get a house in these locations. How high can it go? Well, let's remind ourselves about the distribution of wealth. The richest 20% of Australians own 64%, or 2/3 of all household wealth, top 20%. And between 2003 and 2017, this top 20% grew their wealth by 68%, compared to just 6% for the bottom 20%, the least wealthy 20%. So it's this cohort of Australians that can afford and will drive the property prices in blue chip locations perpetually higher. We're not thinking about macroeconomic indicators here. We're not thinking about the general population. What we're really thinking about is the top 20% that have a desire to live in this location, that continually grow their wealth. Their incomes are rising at a faster rate than the general population, and it's these people that are going to push prices higher. Remember, what we want to do is invest in locations that have the highest probability of having that sustainable and perpetual demand, excessive demand. You've got to remind yourselves you might own the property for 30 years, so you've got to pick a location that's going to remain popular over that time. It's not the next growth suburb. It's not the rising tide that you're looking for in an outer area. It's something that is a steady, consistent performer where there's strong evidence of that past performance. Now, as a reminder, it's just basic logic that you cannot expect above average returns from a below or average quality asset. Whether it's a property or a share or a managed fund or whatever, quality at the end of the day is going to drive all the long-term returns. And so the best thing you can do is invest in the highest quality assets possible, because that reduces your risk. If you've got a pink diamond as opposed to a white diamond, and diamonds become unpopular, the pink diamond's probably still going to be popular and going to give you good returns. So you're protecting yourself for the unknown or changes in the market by leveling up in quality. You're reducing your risk. And the probability is the pink diamond's always going to do better, and the pink diamond's going to appreciate at a faster rate than a typical white diamond. And that's how you need to think of property investing, is you want to invest in that pink diamond. Now, just to wrap up, it's probably tempting for some buyers' agents to buy at any price point. If I generate a whole bunch of leads from prospective clients, I'm going to have a bunch of those leads that probably can't afford to spend $1 million in a blue chip location. But we know that the only way we're going to be able to buy something for a house for $500,000 if we make some compromises with respect to investment principles and investment fundamentals. And what I'm telling you today is there is never a reason to compromise on fundamentals when investing. That is probably the biggest mistake that you can make, and it's an extremely costly one. So if you're going to invest in property, do it well, do it properly. And if that means putting all your eggs in one basket, that is, you can only afford to invest in one property, that's fine. If you can't afford to invest in property, then invest in other assets. Let's not have blinkers on thinking that property is the only asset to invest in. Of course, there's other assets available to us. Okay, that's it from me for this week. I hope that's enjoyable. Please, just as a reminder, if you like the podcast, please rate it and share it wherever you're listening to your podcasts. It certainly does help get it out there and improve the ratings and get more people listening. And until next week, bye for now.